All right, let's dive into pairs trading.
Pairs trading, yeah.
We've got a really interesting YouTube video to unpack today.
Oh, yeah.
It's from Hudson and Thames, and the title is An Overview of Pairs Trading Strategies.
Huh.
And it's actually a part of a larger workshop, so we're dealing with some high-level stuff today.
Okay.
But we'll break it down for the listener.
Oh, good.
Before we get into the complexities, let's just quickly recap the basic idea of pairs trading for the listener.
Sure.
So you're essentially looking for two assets
Uh-huh.
that historically move together.
Like a pair.
Yeah, like two synchronized swimmers.
Okay.
And then you're trying to capitalize on when those two assets
Right.
temporarily drift apart.
I see.
You're betting that their relationship will eventually snap back to normal.
Got it.
So you buy the underperformer and short the overperformer,
Makes sense.
hoping to profit as they converge again.
Right.
Now, the video we're looking at today lays out 5 primary approaches to pairs trading. What I think is interesting about this is each approach is like a different lens through which to view and model that relationship between the assets.
I see. So 5 different ways of looking at it.
Yeah.
Interesting.
And the reason for this variety is because financial markets are so complex and dynamic.
Well, yeah.
What worked flawlessly a decade ago
Sure.
might not be as effective today.
Yeah.
So let's start with the first approach,
Okay.
which is called the distance approach.
Distant approach.
So this one seems pretty straightforward.
Okay.
You're using distance metrics to identify trading opportunities.
Uh-huh.
It's almost like you're measuring the physical gap between those two synchronized swimmers.
Oh, I like that. I like that analogy.
Yeah,
The further apart they are,
right.
the stronger the signal to potentially execute a trade.
Now, the video highlights a landmark 2006 paper by Gatev and others,
Okay.
which initially showed remarkable success using this distance approach.
Interesting.
But here's where it gets interesting. Later research found that its profitability waned after 2005.
Oh, so it worked for a while, but then it
Yeah.
didn't anymore.
So what happened? What do you think happened?
Well, if everyone at the pool starts using the same strategy
Right.
to bet on those swimmers,
Okay.
then the market kind of adapts.
Ah.
The strategy loses its edge.
It's like the market figures out the game.
Exactly.
Okay, got it.
But that doesn't mean that the distance approach is now obsolete.
Right.
Researchers have come up with some variations.
Okay.
Like the quasi-multivariate extension,
Yeah.
which uses different metrics like Pearson's correlation.
Hmm.
And that seems to have yielded more consistent results.
So it's like adding a new layer of analysis on top
Right.
to identify pairs that have a truly robust relationship.
Exactly.
Okay, now let's shift gears to the second approach.
All right.
Co-integration.
Co-integration.
So this one requires a much tighter, more statistically validated relationship between the assets. The video mentions Vidimurthy's book Pairs Trading as like a key resource.
Oh, yeah, I've heard of that book.
Yeah, have you read it?
I haven't read the whole thing, but I've
Yeah.
skimmed it.
So this book outlines a 3-step framework,
All right.
starting with the selection of potential pairs.
Okay.
So you're being pretty selective here at the start. It's
Right.
not just any two assets will do.
It's like choosing your dance partners for like a really choreographed ballet.
Exactly.
Not just any 2 dancers will do.
Yeah, you need that certain level of
Exactly.
compatibility and synergy.
Yeah.
So you're looking for assets whose price movements have a deep-rooted connection.
I see.
Then you rigorously test their tradability,
Okay.
meaning you're assessing if that relationship is stable enough to actually profit from.
Makes sense.
And then finally, you optimize your target levels.
Okay.
So you're determining the ideal entry and exit points
Right.
to
yeah.
maximize your gains.
Right.
Now, this is where it gets interesting for me. The co-integration approach includes something called minimum profit optimization.
Minimum profit optimization.
I mean, focusing on the minimum profit seems a bit counterintuitive. Shouldn't we be aiming for the maximum returns?
It might seem that way at first glance, but minimum profit optimization is really all about managing risk.
Okay.
It aims to maximize the profit that you'd make in like the worst case scenario. So that even if the market throws you a curveball,
I see.
you're still coming out ahead.
So it's like setting a safety net,
Exactly.
ensuring a certain level of return, even if the trade doesn't go perfectly as planned.
Exactly.
Okay, so minimum profit optimization is all about risk management.
Uh-huh.
However, this approach does have some limitations.
Okay.
For example, it relies on the assumption that the co-integration error,
Right.
so that deviation from that perfect synchronization,
Right.
follows a very specific statistical process called an AR1 process. So it's like assuming the dancers will always stay within a certain distance of each other,
Yeah.
But in reality, there might be moments where they need to move further apart.
Right, of course.
For a particular sequence.
Sure, the real world rarely conforms perfectly to theoretical models.
Exactly.
Another interesting variation within the co-integration approach is this concept of a sparse mean-reverting portfolio.
Sparse mean-reverting portfolio?
Yeah.
What's sparse about it?
Well, it's about efficiency and focus.
Okay.
Imagine you're managing a large portfolio of pairs. This approach helps you narrow it down.
Okay.
Selecting only the most statistically significant pairs
I see.
to kind of minimize trading costs and complexity.
So it's like choosing only the principal dancers for your ballet.
Oh, yeah, that's a good way to put it.
Streamlining the performance for maximum impact.
Exactly.
And speaking of analyzing patterns over time, that brings us to our third approach.
Okay.
The time series approach.
Time series, okay.
So this one centers on forecasting those future movements.
Got it.
Of the asset prices or the spread between them.
I see.
So it's like you're studying the choreography, the rhythm and the flow of the dance to predict those next steps.
Yeah.
To do that, they employ various forecasting techniques.
Okay.
A key paper by Elliott and others models the spread as a state space model, uses tools like Kalman filters to predict the future behavior.
Kalman filters, that sounds complicated.
Yeah.
But the underlying concept is pretty intuitive.
Okay.
Imagine you're trying to track those ballet dancers on a stage.
Okay.
But the lights are flickering.
Oh, I see.
So a Kalman filter combines your knowledge of their typical movements with like those intermittent visual cues to estimate their true positions.
So it's like filtering out the noise to get a clearer picture of the underlying pattern.
Exactly.
Okay, the time series approach also utilizes models like threshold autoregression to adjust the trading strategy based on market conditions.
So it's all about adapting to the tempo and the mood of the market.
Right. So instead of rigidly following a preset routine, you're allowing for some improvisation.
I like that.
Based on the music and the energy of the dance floor.
Yeah, that's a great analogy.
If you're looking for a more flexible framework within this time series approach, Sarmento and Horta's TAT book offers a method that can work with a wide range of forecasting algorithms. But the key is to use what are called quantile-based trading signals.
Quantile-based trading signals, okay.
So these essentially trigger trades when the difference between the forecast and the actual price crosses a predetermined threshold.
So you're setting boundaries.
Yeah, like a dance floor perimeter, and reacting when those boundaries are breached.
Exactly.
Our fourth approach, the stochastic control approach.
Stochastic control.
This one gets into the realm of optimal trading rules.
All right, optimal trading, so like the best way to trade.
Yeah, this approach aims to find like the most mathematically efficient way to execute the trading strategy.
Okay, so tell me about this optimal trading.
So a common assumption in this approach is that the spread between the assets follows what's called an Ornstein-Uhlenbeck process.
Ornstein-Uhlenbeck.
Which implies that it tends to revert to a mean value over time. It's kind of like a pendulum swinging back and forth.
Okay.
It's like those dancers, even when they move apart, they're drawn back together by some invisible force.
Yeah.
There's this concept within stochastic control called optimal convergence.
Optimal convergence, all right.
Models in this approach consider both recurring and non-recurring trading opportunities.
So what's the difference?
So recurring opportunities are those predictable moments when the spread widens and then closes again, like a repetitive sequence in the ballet.
Right.
Non-recurring opportunities are those one-off events that might only present themselves once. So this approach aims to find strategies that can capitalize on both types.
Interesting.
So it's like having choreography.
Right.
That works beautifully for both the routine and the improvisational elements of the dance.
I see.
What I find particularly intriguing about this is that some of these models challenge the traditional pairs trading logic.
Like buying the underperformer and shorting the overperformer.
Yeah, like they might suggest holding both assets or even just focusing on one asset at times.
So sometimes the most optimal move might be to step outside those traditional steps.
Exactly.
That's pretty insightful.
It highlights the importance of questioning assumptions and exploring diverse approaches.
Well, yeah.
Before we jump into the fifth approach, which is machine learning, I think we've covered a lot of ground.
We have.
I just want to let all this information sink in for our listener.
Sure.
What are some key takeaways so far that are resonating with you?
Well, it's clear that pairs trading is not a one-size-fits-all approach.
Right.
Each method has its strengths and weaknesses.
Yeah. Yeah.
And the best strategy really depends on your individual goals and risk tolerance.
It's not just about blindly applying a formula.
Right.
It's about understanding the nuances of each approach.
Yeah.
Choosing the one that best aligns with your investing style.
Exactly. Exactly.
So we have to keep that in mind as we continue.
And as markets evolve,
Yeah.
we have to continuously research and adapt our strategies.
Yeah, like refining your dance technique to keep up with the latest trends.
Exactly. Now let's step into the fifth approach, which is all about harnessing the power of machine learning for pairs trading.
Oh, this is where things get really cutting edge.
Yeah.
The video mentions that machine learning can be used for both pair selection and for generating trading signals.
Right.
So it's almost like we're bringing AI to the trading floor.
It does feel that way.
And while there are similarities with the time series approach in terms of forecasting, machine learning introduces a whole new toolkit for analysis. So imagine having like a supercomputer as your dance partner, able to analyze all those data points and anticipate market movements.
That's powerful.
With incredible speed.
Yeah.
And when it comes to pair selection using machine learning, there's this three-step framework. First, you use dimensionality reduction techniques to simplify that vast universe of potential assets.
So instead of being overwhelmed by a crowded dance floor, you're narrowing it down to a select group of promising partners.
Then unsupervised clustering algorithms come into play. And these algorithms group assets with similar characteristics.
So it's like sorting the dancers by their style.
Yeah, waltz experts over here, tango aficionados over there.
I like that.
And finally, specific selection criteria, such as co-integration tests or measures of spread reversion, are applied to pinpoint the most promising pairs within those clusters.
So you're choosing those dance partners who not only look compatible, but also have a proven track record of moving in sync.
Exactly. And there's been some fascinating research in this area, particularly on applying machine learning to specific spreads in commodity markets.
Like what?
Like gasoline, soybeans, corn.
Interesting.
The video mentions Dunas as a prominent researcher.
Jonas,
who has done a lot of work using neural networks and various filters to generate trading signals.
Neural networks, those are the algorithms inspired by the human brain.
Yeah. Complex algorithms capable of learning intricate patterns from vast amounts of data.
Wow.
And when they're combined with carefully designed filters, they can provide really valuable insights for pairs trading.
So it's like having a dance coach.
Yeah.
With like an encyclopedic knowledge of steps.
Yeah, and the ability to adapt them to any situation.
That's a great way to put it.
Now, remember those other approaches that were mentioned in the video?
Yeah.
Two of them deserve a closer look, I think.
Okay, which ones?
The copula approach and the PCA approach. So the copula approach caught my attention. It's described as relatively new, but potentially very powerful.
Interesting.
What's the key concept here?
Well, copulas are mathematical tools that allow us to understand the relationship between two assets. In a more nuanced way than just looking at correlation. They capture the entire dependent structure, including how those assets behave in extreme market events.
So instead of just observing how smoothly the dancers move together during a waltz, you're also analyzing how they react when the music suddenly changes.
Yeah, or the dance floor gets crowded.
Exactly.
Got it.
And there are different types of copulas, each with its own strengths. Vine copulas, for example, are particularly powerful because they can handle complex, multi-dimensional dependencies.
So it's like a choreographer
Yeah.
who can create routines that work beautifully in a variety of settings.
Exactly. From an intimate waltz to a large-scale ballroom performance.
A brilliant analogy.
The PCA approach takes a different route. It involves decomposing asset returns into systematic and idiosyncratic components.
PCA stands for Principal Component Analysis. It's a way to identify like the primary factors that drive variation in a data set.
That's right.
In pairs trading, PCA helps us separate those market-wide movements that affect all assets from the unique asset-specific fluctuations that create trading opportunities.
So you're distinguishing between the overall rhythm of the music, which influences everyone on the dance floor, and the individual improvisations that make each dancer stand out.
Exactly. To do this, we can regress asset returns on a market representative, which could be a PCA eigenportfolio or sector ETFs.
Eigenportfolios, now we're getting into some serious financial jargon.
Well, think of them as portfolios that represent like the core patterns of co-movement in the market.
Okay.
Like identifying the signature steps
Got it.
that define a particular dance style.
Once we've isolated the idiosyncratic component of asset returns, we can use models like the Ornstein-Uhlenbeck process to identify those moments when an asset deviates from that market trend.
I see.
And bet on its eventual return to the norm.
So you're looking for those instances when a dancer breaks away from the choreography.
Right.
And then predicting when they'll rejoin the formation.
And what's great about this approach is that it can be further refined to account for market volatility.
So it's like adjusting the steps to accommodate changes in the music's tempo or the energy level on the dance floor.
Now, having explored all these different approaches to pairs trading, what are some key insights our listeners should take away?
Well, first and foremost, pairs trading is not a one-size-fits-all strategy.
Definitely not.
The best approach will really depend on individual investment goals, risk tolerance, and market conditions.
Absolutely. And as with any investment strategy, continuous research and adaptation are essential.
The market is a constantly evolving dance floor.
You need to stay agile to keep up.
Precisely.
Yeah.
And this brings us to an important question for our listener.
Yeah. What's that?
With all these approaches to pairs trading,
right,
which ones resonate most with you and your investment style?
Which ones pique your curiosity and align with your risk tolerance?
It's like finding the dance style that suits you best.
Right.
Whether it's the structured elegance of the waltz or the improvisational flair of the tango.
And remember, this is just the tip of the iceberg. There's a whole world of resources out there to explore, deepen your understanding.
And one thing I always emphasize is that even though we've categorized these approaches, you know, the lines between them can be blurry.
Okay.
In practice, you might combine elements from different approaches to create a strategy that truly fits your needs.
It's more of a spectrum of techniques than rigid boxes.
Exactly.
Right.
You might use machine learning to narrow down your potential pairs and then apply like a co-integration approach.
Right.
For fine-tuning your trading signals. Or you could blend time series analysis with stochastic control to develop a more dynamic strategy.
You know, it's all about finding the right blend of tools and techniques to match your investment goals and your view of the market.
It is, and that's what makes this field so exciting.
I agree.
It's not just about crunching numbers.
Right.
It's about applying those analytical skills in a creative way.
Yeah.
Almost like, you know, choreographing your own unique trading strategy.
You know, as we've been discussing these different approaches, it struck me that at its core, pairs trading is really about recognizing relationships.
Oh, relationships.
Relationships between assets.
Right.
That might not be immediately obvious, but offer really valuable insights.
It's a way of seeing connections that others might miss.
Exactly. And that makes me wonder if this kind of thinking could be applied to other areas of life.
Oh, like what?
I'm thinking like social dynamics.
Okay.
Behavioral economics. Maybe there are like underlying patterns of influence and interaction that could be uncovered using a similar approach.
It's a fascinating question.
What are your thoughts?
I think it's worth pondering.
Yeah.
As you continue your exploration of pairs trading, perhaps you'll see parallels in how seemingly unrelated events or behaviors can be linked by some underlying forces.
It's like realizing that those seemingly random steps on the dance floor are actually part of a larger interconnected pattern.
Exactly.
Who knows what other insights you might uncover when you start looking for those hidden connections.
Well, on that note of encouraging further exploration, I think it's time to wrap up this deep dive into pairs trading.
I think so too.
Hopefully you found it informative, engaging, and most importantly, empowering.
Absolutely.
And as you delve deeper into this fascinating field, remember to stay curious, challenge assumptions, and never stop learning.
Good advice.
The world of finance, like the world itself, is constantly evolving.
That's true.
There's always something new to discover.
Perfectly said. Thanks for joining us on this journey, and until next time, happy trading.